And for 95% of the population, debt-free is a good idea because you don't know anything about money.
America's economy did stabilize in 2023. The S&P 500 saw an impressive 15.9% growth through the year's first half, a rebound that exceeded many analysts' expectations after 2 years of significant turmoil. Still, the picture might not be as rosy as it looks, according to Robert Kiyosaki, who warned of a possible market crash landing after the U.S. credit rating took a hit. Setting the stage. Those familiar with Robert Kiyosaki will tell you he's the author of the groundbreaking personal finance book, Rich Dad, Poor Dad. They're right, but he's more than just an author. He's a financial guru. He's been issuing a flurry of warnings about the bleak future of the U.S. economy over the years. And you know what? Most of those warnings have proven eerily accurate in the past. From his cautionary notes before the housing market collapse to his bold calls for a market correction, Kiyosaki's words haven't just been words. They've been a harbinger of financial shifts that have impacted America's fiscal landscape. This time, the prominent investor warns of the dire consequences of the plummeting U.S. credit ratings, calling for a looming downturn and an epic market crash landing.
This is the biggest crash we'll ever see in our lifetimes. It's called the everything bubble. Everything's going to come down. And that's how you can prepare for it.
Brace for crash landing. Kiyosaki has ramped up his warnings in recent months. In his recent tweet, he slammed the Wall Street Journal for claiming that America's economy is strong, adding that America is broke. WTF, WSJ claims economy is strong. Don't they know the stock market is up because Biden raised debt ceiling? America's debt is going up, so stock market going up. Numbnuts, America is broke. You'll want to know that Kiyosaki is a vocal critic of the U.S. President Joe Biden administration. He emphasized that the surge in the stock market resulted from Biden signing the bill to raise the debt ceiling. Underscoring the financial fragility of the nation, he reiterated that he doesn't trade stocks and bonds as he prefers more control over his assets.
But I say I don't invest in anything they can print. I don't invest in this, stocks, bonds, ETFs.
He also mentioned his preference for gold, silver, and Bitcoin investments. I do not play the stock or bond markets. As an entrepreneur, I like my hands on control too much. Yet too many signs point to a severe stock market crash. If your future depends on stocks and bonds, please be careful. Possibly ask for professional advice. Afraid depression coming, he noted. In the past, Kiyosaki has pointed to a wide range of issues, from high inflation to skyrocketing government debt and questionable central bank policies. But the author's latest concern about America's bleak future was echoed by Fitch Ratings. Shortly after his tweet about the stock market, Fitch Ratings Inc., one of America's big three credit rating providers, slashed the U.S.'s long-term foreign currency issuer default rating from a sterling AAA to AA+. When Fitch lowered the U.S. credit rating, Kiyosaki's response was as straightforward as ever. First shoe to drop. Fitch Ratings Services downgrades U.S. credit rating from AAA to AA+. Brace for crash landing. Sorry for the bad news, yet I have been warning for over a year the Fed, Treasury, big corp CEOs have been smoking fantasy weed. Take care, Kiyosaki said in a tweet. According to Rich Dad, Poor Dad author, Fitch's decision to strip the U.S. government of its prized AAA rating is the first sign of a market crash landing. It's worth noting that this is only the second time in U.S. history that the nation's credit rating has been downgraded. Fitch joined Standard & Poor's rating agency, which cut its U.S. credit rating to AA+ in 2011, following a prolonged political fight over whether to raise the government's legal debt limit. In a 2012 report, the Government Accountability Office estimated that Washington's 2011 budget impasse increased Treasury's borrowing costs by $1.3 billion. The immediate outcome of Fitch's downgrade saw a notable flight to safety among investors and traders. We saw a considerable shift from stocks to safer assets like government bonds and the U.S. dollar. But what exactly informed Fitch's decision to lower the U.S. credit rating? Fitch cited several reasons for its decision, and here are the main ones. Rising debt. America has seen its debt rise steadily in recent years. At 112.9% this year, The nation's debt is well beyond the 100.1% mark recorded before the pandemic in 2019.
The U.S. is doing today is they're printing money to pay the interest on that debt. So that's like you can't buy food. So you go out and you buy food on a credit card. Then tomorrow you go out and buy more food on a credit card. Eventually they're going to say, well, this has got to end. And that's what the governments of the world are doing.
Analysts predict the government's debt to GDP ratio will reach 118.4% by 2025. That debt ratio exceeds the requirements. It's over 2.5 times more than the AAA average of 39.3% of GDP and the AA average of 44.7%. Fitch's long-term estimations project even further increases in the debt to GDP ratio, raising concerns about the country's fiscal position and the ability to repay its debts in the future. Erosion of governance. According to Fitch, the U.S. standard of governance has steadily deteriorated over the last 2 decades. This deterioration has stemmed from a combination of factors, including growing political polarization, example, Trump's effort to overturn the election, recurrent last-minute resolutions of debt and fiscal matters, and the June agreement to suspend the debt limit until 2025. These factors, coupled with several economic shocks and new spending initiatives, have contributed to an erosion of governance that informed Fitch's decision to downgrade U.S. debt. Fed tightening. The Federal Reserve has raised its benchmark interest rate, the Fed funds rate, by 25 basis points in 2023, making it the highest since 2007. Still, Fitch speculates one more hike to around 5.5% to 5.75% by September. Furthermore, the Fed continues to reduce its holdings of mortgage-backed securities and U.S. Treasuries, further tightening financial conditions. From January to July 2023, Fed's assets have fallen in value by over $500 billion, making it even harder for people to secure loans. But how does a credit cut affect you? Generally speaking, a lower credit rating is bad news for the country and taxpayers alike. When your credit score as a consumer drops, or your credit rating as a country, you're perceived as less creditworthy. That means lenders will charge a higher interest rate when you borrow money. As you may be aware, paying more interest can hurt your finances in the future. Thus, this downgrade raises borrowing costs for the U.S. government and hurts your finances as a taxpayer. Potential impact of a market crash. A market crash can have far-fetching consequences on the economy of any nation. Some of the effects of market crashes include 1. Reduced consumer confidence. Imagine that you have invested systematically for years in the stock market, amassed a certain amount of wealth, and are planning to retire. Then, out of the blue, the market crashes, and all your wealth is washed within days. What will happen? Your confidence in the market automatically decreases. The upcoming investors will also become shaky and will stop making systematic investments. When people see their investments and retirement savings erode, they become more cautious in their spending, which can impact consumer-driven sectors of the economy. 2. Investment losses. A market crash can cause a significant decline in the value of stocks, bonds, and other investment assets. Investors with retirement accounts such as 401ks or IRAs may experience substantial losses. Moreover, individuals close to retirement may need to delay their plans due to reduced retirement savings. Those relying on investments to fund their retirement may need to reevaluate their financial strategies. 3. Economic slowdown. A severe stock market crash can have a cascading effect on the broader economy. Reduced consumer spending, lower business investment, and financial instability can contribute to an economic slowdown or recession. The worst part? As most wealth gets washed out during an economic downturn, covering it up is challenging. 4. Financial institutions. Financial institutions that have exposure to the stock market may face significant losses.
We're right at the brink of starting to find out that the amount of selling of government debt collapsed, right? We didn't issue government debt. And now we're going to issue a lot of government debt. And so when we look at the buyers, there appears to be a significant shortage of the buyers for that government debt. But we're now at the brink of being able to see what that supply-demand picture looks like as we go over the next year and two.
In extreme cases, a stock market crash can lead to the insolvency of banks and other financial institutions, potentially triggering a broader financial crisis. 5. Global impact. Clemens Wenzel Fürst von Metternich, a Prussian diplomat, once said, "When America sneezes, the world catches a cold." That's true, considering how today's global economy is interconnected. A stock market crash in one country can have ripple effects on global markets. The US stock market crash can trigger a chain reaction across several other countries, affecting international trade and investments. The shockwaves from a crash can quickly affect economies worldwide. Other experts and analysts stance, but does the downgrade by Fitch have such severe consequences on the US economy? Are we as a nation on the brink of a market crash landing, as warned by Kiyosaki? So far, whether this move will threaten America's fiscal health remains to be determined. Some analysts and economists have weighed in on the matter, and many doubt the impact will be that severe given the vast scale of the Treasury market and the consistent investor demand for U.S. Treasury securities. Though Fitch's downgrade came as a shocker, it didn't reveal anything investors didn't know about the economy, according to experts. Therefore, the downgrade could be more of a seasonal correction than a new shock stressor, as per experts' opinion. Fitch's downgrade reflects a reality that investors have already learned to accept, so while today's equity market response was negative, it does not add anything new to the discussion. DataTrek co-founder Nicholas Colas wrote, "We should not, therefore, be too surprised at today's price action." The Biden administration also pushed back, disapproving of Fitch's rating approach and claiming that the downgrade didn't mirror the U.S. economy's accurate outlook. Fitch's move changes nothing concerning what Americans, investors, and people all around the world already know: that Treasury securities remain the world's preeminent safe and liquid asset, and that the American economy is fundamentally strong, Treasury Secretary Janet Yellen said in a statement. Ms. Yellen called the downgrade arbitrary, noting that Fitch's rating model had shown U.S. governance deteriorating from as far back as 2018, but hadn't downgraded until now. Wall Street commentators Larry Summers, Warren Buffett, and Jamie Dimon also slammed Fitch's move, terming it bizarre and ridiculous. Practical steps for investors. Ultimately, Kiyosaki's statement serves as a wake-up call for awareness and preparedness. While no one can predict a potential economic crisis's exact nature and timing, his message highlights the importance of being prepared.
There are changes now in terms of the quantities in the world that are being held by large investors around the world that have lost money in these treasury bonds and so on. And then there are geopolitical changes which are having an effect. Some cases, some countries are worried about sanctions. And then there's this geopolitical shift.
Below are practical steps individuals and investors should take to avoid a possible market crash. 1. Stay educated. Stay informed about economic trends, geopolitical events, and other factors impacting the global economy and financial markets. Knowledge will empower you to make informed decisions. 2. Diversify your portfolio. One of the fundamental principles of investment is diversification. Explore alternative investment options like precious metals, cryptocurrencies, or peer-to-peer lending platforms. These can provide diversification beyond traditional investment avenues. 3. Regularly review your investments. Stay informed about the performance of your investments. Periodically review your portfolio and make adjustments based on changing market conditions and your financial goals. 4. Invest for the long term. Market fluctuations are inevitable, but history has shown that markets tend to recover and grow over the long term. Focus on your long-term investment goals and avoid making impulsive decisions based on short-term market volatility. 5. Avoid herd mentality. Getting caught up in the crowd's emotions is easy during market uncertainty. Avoid making investment decisions solely based on the actions of others. Do your research and make decisions that align with your financial objectives. 6. Review and update your financial plan. Your financial plan should be dynamic and adaptable. Regularly review and update it based on changes in your circumstances, risk tolerance, and market conditions. 7. Focus on cash flow. If you're invested in rental properties or other income-generating assets, prioritize maintaining positive cash flow. Rental income can provide stability even during economic downturns. If you learned something valuable from this video, please like, share, and comment below. Also, if you want to stay on top of this roller coaster ride, Hit that subscribe button and ring the notification bell to avoid missing our upcoming videos. And be sure to check out our next video to stay financially savvy.